When most investors think about the Indian IT sector, three names usually come to mind: TCS, Infosys, and HCL Technologies. These companies dominate headlines, attract institutional money, and are widely tracked by analysts. But interestingly, there is another IT company that has been quietly executing in the background. Over the last 5 years, this company has grown its revenue at a 27% CAGR. It works with 20 Fortune 50 companies, and yet it rarely becomes the center of discussion among retail investors. At a time when many investors believe the IT sector has already matured, this particular mid-cap company has actually grown faster than several large IT giants in recent years. That company is Persistent Systems. So the real question is Persistent Systems truly a long-term IT compounder, or is it simply another mid-cap IT stock riding a temporary growth cycle? In today's video on Analyst Desk, we will break down the full story of Persistent Systems, its business model, growth drivers, financial performance, and the key risks investors should understand before adding it to their watch list. So let's start. Before we move further, it's important to briefly look at the leadership behind Persistent Systems. The company is led by Sandeep Kalra, who serves as the Executive Director and CEO. He brings more than 30 years of experience in the IT services industry. Under his leadership, Persistent has significantly strengthened its digital engineering capabilities, building on the company's existing expertise. Before we look at numbers, it is important to first understand what business Persistent Systems actually does. Many investors assume it is just another IT outsourcing company. But the company positions itself slightly differently. Persistent describes itself as an AI-led digital engineering and enterprise modernization partner. In simple terms, the company helps global enterprises build modern digital infrastructure. This includes developing digital platforms, migrating enterprise systems to the cloud, implementing artificial intelligence solutions, and modernizing legacy technology architecture. The company has been around for more than 35 years. During this period, it evolved from a niche product development company into a global digital engineering services provider. Today, Persistent works with 20 Fortune 50 companies, several global banking institutions, and large pharmaceutical and healthcare organizations. This client profile itself indicates that the company operates in the enterprise technology services segment, where long-term client relationships are extremely important. Let us move to the most important metric when evaluating any business, that is growth. Between FY20 and FY25, Persistent Systems delivered 27.3% revenue CAGR with 33% profit CAGR. For an IT services company, this level of growth over 5 years is quite significant. In FY 2025, the company's consolidated revenue crossed $1.4 billion, and the growth momentum has continued. In the first 9 months of FY 26, revenue has already grown 23% year on year. If we look at the most recent quarterly numbers, the company reported $422.5 million revenue in Q3 FY26, representing 17.3% YoY growth. Shocking part is company has sequential growth from last 11 quarters continuously. Consistency like this is not very common in the IT services sector, especially during periods when global technology spending becomes uncertain. Another important aspect to understand is where this growth is coming from. Persistent operates across three primary industry verticals: software, high-tech and emerging industries, banking, financial services, and insurance, healthcare, and life sciences. Over the last few years, these segments have shown different growth patterns. Among them, the healthcare and life sciences vertical grew at 37.1% CAGR over the last 5 years. At the same time, the BFSI segment recorded 35.7% year-on-year growth recently, making it one of the key drivers of the company's recent expansion. This diversification across industries is important because it reduces the company's dependence on a single sector. For IT services companies, diversified client industries often lead to more stable revenue streams across economic cycles. Another indicator investors closely watch in IT services businesses is the deal pipeline, because future revenue growth often depends on the size of contracts already signed. Persistent recently reported $2.32 billion total contract value and $1.68 billion annual contract value. Both metrics have grown double-digit year-on-year. A healthy deal pipeline like this generally indicates strong revenue visibility for the next few years. It also shows that large global enterprises continue to trust the company for long-term digital transformation projects. In the IT services industry, profitability is heavily influenced by employee productivity and utilization levels. Persistent has shown improvement in this area. Employee utilization improved from 78.5% in FY20 to 88.4% in Q3 FY26. Higher utilization typically leads to better operating margins, and that trend is visible in the company's numbers. Operating margins improved to 19% in the first 9 months of FY26. One reason for this improvement is the company's increasing use of artificial intelligence tools within its service delivery process, which helps optimize operational costs. Apart from growth and profitability, investors should also evaluate the financial strength of the business. Persistent Systems currently maintains a very conservative balance sheet. The company's total debt to net worth ratio is only 0.1 times, and its interest coverage ratio stands at 37.6 times. In simple terms, this indicates extremely low leverage, strong internal cash generation, and a very comfortable financial position. For long-term investors, balance sheet strength plays an important role in reducing downside risks during economic slowdowns. Of course, no investment opportunity is completely risk-free. Persistent also has a few structural risks investors should be aware of. One of the biggest is geographical concentration. Around 80% of the company's revenue comes from the United States. This means that any slowdown in US technology spending could directly impact revenue growth. Second, the IT services sector remains highly competitive, with both global consulting firms and Indian IT giants competing for similar enterprise clients. And finally, while artificial intelligence creates opportunities, it could also change traditional outsourcing models in the long run. How companies adapt to this transition will determine their future competitiveness. So coming back to the original question, can Persistent Systems become the next long-term IT compounder? The company clearly has several positive factors: strong revenue growth, a high-quality enterprise client base, increasing positioning in AI-driven digital engineering services, and a very strong balance sheet. However, like most IT companies, its future performance will still depend on global technology spending cycles and enterprise IT budgets. For investors who track long-term technology trends, Persistent Systems is definitely a company worth keeping on the watch list for further research. Brokerages are largely bullish on Persistent Systems right now. Motilal Oswal has one of the highest targets at 8,500. JM Financial is also positive, with a target around 7,600. But not everyone is fully convinced. ICICI Securities has a more cautious stance, with a target closer to 6,400. Currently, Persistent share price is trading near 4,700. You can read those reports to understand their rationale. I will attach them in description box. Well, that's all from my side. If you like this analysis, please like this video and share with your friends for better reach. See you in the next video. Take care.